Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, September 25th, and I found a surefire way to get feedback on our videos. Just post one where the audio goes bad halfway through, and there will be no shortage of feedback for that video. So let's give this another shot. Let's see. Part two. Okay, state of the market. Mild correction. About 6% off the highs in the S&P 500, which we made in late July. Check over here at the trend gauge, market leadership. We downgraded market leaders as well as our short-term and intermediate-term trend last week based on, very weak action and leadership, RG8, and losing around 2/3 of the 21/21 list. Short-term clear break of the now rolled over 21-day exponential moving average on all 5 of the indexes. Same thing on the medium-term 50-day moving average. Long-term, we've got a mixed bag. Small and mid caps are beneath the Dow, bounced off the 200-day today. Large caps in the NASDAQ 100 or the S&P 500 and the NASDAQ 100 still above the 200-day moving average. So what happened today? After three days down, we had a gap down of 0.25% at the beginning of the session, and that put us 3 ATR below the 21-day moving average. That's very stretched to the downside. We've been looking for a bounce, and we got it at that level. That's also the lows of today near that the bottom of that 7-layer burrito of support we've been talking about. So pretty important line in the sand. As of today, the last line of defense right above 4,300, and we bounced there from being extremely oversold. So we got to see what the market can bring us now. So gap down, reverse higher, and this was done in the face of yields making recent highs, and also the U.S. dollar making recent highs. So market shook that off today, but it can't be ignored. It's a very clear headwind. Here are the final numbers. Our 8 growth ETF composite, the RG8 up 0.36%, S&P up 0.4, NASDAQ 100 up 0.5%, Dow up 0.13, mid caps up 0.6, Russell 2000 small caps up 0.4, Global Diversified 60/40 stock and bond down 0.13, bonds the culprit here. Yields up, that means prices down across the board. In-house GROTECTION, we've got 60% exposure to the S&P 500 via SSO. So while we're in no man's land here, we're going to get 60% of the return of the S&P 500, whether it's to the upside or the downside. Today was to the upside after being stretched. We'll hit the tail of the tape and the rebuilt 21/21 list. Let's get right into it. S&P 500, you can see here, 3 days down, gap down, reverse at this 4,300 level. That's the line in the sand for now. That's also, as I said, 4,300, a pretty big level as far as the support. Same thing for the NASDAQ 100, 3 days below this purple line. That's the 100-day moving average. Break the lows of the last 2 days and rally back above. Note, unlike the S&P 500, the NASDAQ 100 has not broken the lows of mid-August. Let's go to the Dow. Here's the Dow bouncing off the 200-day moving average. Now the two weak links in the chain, mid caps and small caps, you can see they're below the 200-day moving average. They also undercut the prior 2 days lows and bounced. There's mid caps. Here's small caps, same situation. Note the terrible relative strength that we've seen over the last 8 weeks. Let's flip to the VIX. VIX did something that bulls would want to see, got back above the 200-day moving average and then failed with the reversal closing at the lows of the day. Poked its head above this 18 level, which it also poked above on 818, which was the recent lows, and then closed back below it. So holding the 200-day moving average above the shorter term moving averages. Bulls want to see the VIX get back below 15. That's where the rally has taken place for the most of this year in June and July, certainly, and then recently until we gave up the ghost. There's the VIX. Let's go to the dollar, and this is where things start to not look so good. Not look so good if you're a bull anyway. Higher highs for the dollar, not good. You know the inverse correlation with precious metals. So as we would expect. Gold down 0.5%, but gold not making lower lows the way the dollar's making higher highs. So a minor positive divergence there, something we're keeping an eye on. Same thing with gold stocks, weak, down 1.25% today, but they did close mid-range. They were down over 2.5% at one point. And silver, also down 1.76%. I'm expecting these to rally if we would get weakness in the dollar. As I said, positive divergence there with them not making new lows while the dollar is making new highs. Bitcoin trading kind of in a tight range, down 0.73%. Really nothing to look at there, but definitely something to look at here for bonds. If price is making lower lows, both on the broad index and on the long term, lower lows, that means our yields are going to be at highs, and there they are. There's your TYX, second gap up in 3 days. That's the 30-year. TNX, the 10-year, another second gap up in 3 days, also very stretched to the upside. So that's our inter-asset correlation. Let's go to the tail of the tape. I'll pause this, or you can pause it, and I'll hit the highlights. We're oversold or overbought in an extreme on what we want to see from the stochastics, the RG8, the NASI, RSI, and then to the upside on the dollar and rates. So one side of the boat's going to get too full, and we're going to have a reversion to the mean. We don't know exactly when. The news of the potential government shutdown, stocks don't seem to like it. We'll see how that plays out. So with us putting in a low and reversing and closing up, the day count goes from 3 down to an O'Neill rally attempt day 1. Ideally, we want to look for follow-through days on day 4 through 7, but we've also got to have some leading stocks that we're interested in putting our money into, and that is a little tougher order. 7th day below the 80 EMA and the 21 EMA. Obviously, our expectations negative with us being below the 21. Sector highlights: oils, banks, and uranium on to the upside, and then to the downside, gold and silver stocks, and some defensive sectors, staples, utilities, and real estate. No change to the portfolio. The only thing we own is SSO, which is the equivalent of a little over 60% of the S&P 500. Adjusted beta, no change at 0.61. Bottom line for the day: indexes gap down on the 4th day, and then reversed higher where you would expect it to. At the -3 ATR and that 4,300 support level, closed at the high of the day. It's day 1 of the rally attempt. Let's get into the 21 over 21 list, which has been rebuilt. I didn't have a shortage. We had like over 180 stocks that are still above their 21. Now, this isn't a typical 21-21. There's some defensive things on here that we wouldn't really buy, but monitoring this and having a diverse number of sectors on here tells us if the defensive stuff starts weakening, we may see that money flowing into some of the more growthy names. And if they get back above their 21, we've got a bunch of alerts set. We're ready either way. Molina Healthcare, medical managed care, improvement in this group. United Healthcare is in this group. It dragged the Dow down for a while, but these are looking better. Definitely a defensive area. SAM, their seltzer fiasco of 2021 in the rear view mirror. Nice reaction to their most recent earnings, working sideways, gathering relative strength while the market corrects. QLYS, probably the best chart in certainly one that's held up above the 21 in security software. CrowdStrike closed below it. Zscaler also, and OKTA, and those look pretty good. So some nice charts in here. We need the market to cooperate. Ciena, fiber optics, gapped up on its earnings report, pulled back, sitting on the 21, needs to hold it. FedEx, up their last week, up their guidance. They're got their business model together, certainly a lot better than UPS does. Nice growth rates with a PE of only 16. Relative strength at a new high. TXT, aerospace defense stock, gapped up on a contract that they won, or a new sale, something like that last week with NetJets. And 2-day tight pullback, 3rd day pullback, positive outside reversal. This is a nice setup here. Abercrombie and Fitch, my kids wore this stuff 15 years ago. I guess kids are still wearing it today. Sitting on the 21 after a nice gap up on earnings. Ollie holding up okay. Negative reversal after its earnings gap up, but that could be market attributed. As you can see, that's about the time when the market started to give it back. This is black line up here is the S&P 500. CF Industries making new recent highs. These often zig when the market is zagging. It has a lot to do with the food supply. I saw idiot John Kerry saying we need to reduce the food supply in order to solve climate change. I mean, what dumber statement could you ever hear out there than that? We want people to starve to death, right? Fabrinet, gap up going sideways, data center play. CEG, Constellation Energy, nice action here, bouncing off the 21. Mobileye, the only semiconductor above its 21. Nice accumulation recently. This one may be having a resurgence. Bellring Brands going sideways, tight sideways after breaking out of a base, showing relative strength. Akamai, we added this on Friday. Nice breakout, but breakouts don't make progress in a market like this. 2-day pullback, double inside, very tight action on Akamai, positive accumulation. You can see by the blue bars there. And then the 7 carryovers from the prior week: Dell, ESTC, Nutanix, CCJ, uranium play, making new highs. CEIX, coal stock. NRGU, energy stocks are correcting but not breaking. And TBT making new highs along with interest rates. Kind of a quick video since it's number 2. And like I said, that's one way to get feedback is to mess up the video. No idea what happened, technical difficulties. It happens from time to time. But if you're interested in reaching out, I'm at don@revereasset.com. If you're interested in becoming a client, you've been keeping my partner Dan busy lately, dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. We know you can't make money in leading stocks right about now, but we are using the passive part of our portfolio, which we keep some allocation to as long as we're above the 200-day moving average. The market never gets into serious trouble as long as it holds that level. All bear markets occur below it. So we're willing to keep some exposure on, but not in leaders. Take advantage of the sector rotation that happens within the S&P 500. And with that, I'm going to wrap up the second edition of the video for Monday, September 25th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.